Hi, I just got back from Australia, a 5-city tour. I was gone for 11 days. I was on the ground there for 8 days. We did Sydney, Perth, Melbourne, Adelaide, Brisbane, the 5 major cities there. We did not do Adelaide when I was there in February. It was also unusual that they had me back in November because I was there in February. Normally I go to Australia every year or a little longer. And there was a reason for this. Real estate markets are starting to crack in Australia, and they have the strongest real estate markets in the developed world. In fact, they're now the most overvalued outside of China. And then, of course, you know what we think about China, the greatest bubble in history. And Hong Kong has 19 times income to buy a house, the most developed part of China. And in Sydney, it's 10. In Melbourne, it's 9. Those are the most overvalued developed country cities in the world, along with Vancouver in Canada. So you know, something's happening there. And there was a 60 Minutes show there that was had some key people warning, like I've been warning for years there, that you could see as much as a 40% crash. I see that or more. And Martin North was one of those. He's from Digital Finance Analytics. He's an incredible financial analyst, real guy, totally objective, has the facts on everything. I mean, he's my type of guy. So I met with him and John Adams, a minority economist there that's also warning about a much deeper downturn than Australians have seen. And you got to remember, Australians have such strong demographics from such strong and high quality Asian immigration. 28% of their population is foreign born. And these immigrants are higher than average income and education and everything, not lower. So that's a very strong thing. And of course, they have strong Chinese buying there, laundering money out of their country. I mean, you know, they love Sydney and Melbourne and Brisbane and places like that. So there's a reason their economy's been strong. There's a reason their real estate has been so strong, but nothing can go up forever. And I love real estate because real estate's real. Real people have to buy and live in it, and offices, real businesses have to buy and operate it out of it. So real estate can often have limits to a bubble before stocks, because stocks can just go crazy, and tulip bulbs can go crazy, and cryptocurrencies can go crazy because people don't have to live in them and that sort of stuff. And that's what I see happening in Australia. I think this is an important moment for Australia. That's why Greg Owen at GoCo Management brought me back earlier than usual in November. I think it's also an important indicator for the world, because what I see happening in Australia is similar to what I saw in the US back in 2006. In late 2005, we warned that the real estate bubble in the United States was about to peak. Sales had already started to fall. That's a leading indicator. And guess what? By April 2006, prices peaked and started to fall. Mortgage stress started rising and more mortgage defaults and subprime, problems. And everybody thought, oh, it's containable. It's only a small percentage of loans. And it just got worse and worse and worse. Real estate was the leading indicator, and the U.S. was the bubble most prone to burst because of our subprime, our terrible lending. I mean, the most liberal lending in all of history. Canada didn't do that. Australia didn't do that. Most of Europe didn't go as far as we did in the types of no down and no doc loans and all this sort of stuff, and teaser rates and all this sort of stuff. So we were the trigger for a global bubble already ready to burst because of demographics and unprecedented debt levels. Well, I think that's what's happening in Australia today. Their Teflon real estate market in an economy that's still strong. They're just like we were in 2006. Their real estate prices, especially in the leading cities, Sydney and Melbourne, peaked in mid-2017. And now they're down 8 to 9% in Sydney and maybe 6 to 7% in Melbourne. But in the higher end areas and suburbs and beach areas and stuff, they're down 15 to 19%. And that's where the foreign buying and the more affluent starts. And I've been warning, this real estate bubble is going to be the opposite of the subprime. It's going to start at the high-end markets, fed by foreign buyers and affluent people in this bubble, and then filter down into the lower end markets over time. And that's what's happening in Australia. I see it as a leading indicator, just like it was in early 2006. The stock market in the US did not peak until October 2017. A year and a half later, the economy did not go into recession until January of 2008. Months after that, I see Sydney and Melbourne's real estate cracking as a leading indicator, not only for Australia's economy peaking in the stock market by late 2019 and then starting to head down, but the whole world. And again, Sydney and their markets are peaking just because they're overvalued. There's no trigger from the economy. They have not even raised short-term rates like our Federal Reserve has. They will, but they haven't. Their bond rates, long-term rates are going up somewhat. But one of the best indicators, again, from Martin North, which he allowed me to use with our attendees in Australia, was mortgage stress. Now, this is the best analysis I've ever seen. I can't even get this in the United States to this level. He had mortgage stress first, not just by income levels or cities or something, by lifestyles. It was the more affluent, older households and the most affluent younger households that are the most in stress. Stress rates of 12, 13%, say, versus maybe 5, 6, 7, 8 in everyday households. That's not supposed to happen. And that didn't happen in the subprime crisis here. It was the lower end households that defaulted from these teaser loans and loans really they couldn't have afforded that were encouraged strongly by the government and Wall Street here. So this is showing a different process. It's starting on the high end. It's going to move down. And I think their real estate prices have peaked. Martin North's analysis also showed overall stress rates on mortgages have spiked in the last several months. That is a sign that the crisis is starting, probably the best single sign you could find. Their real estate sales and volume have fallen just like they did in the US. So I think this is a leading indicator. And again, I think everybody should be watching this because Australia is the strongest real estate market in the developed world. And again, China's still an emerging country overall. In the developed world, they are the most overvalued, only rivaled by Canada. And then the UK and places like that. And we're not as overvalued as Canada or Australia here in the United States because we already got hit hard in the great financial recession. But we are as overvalued in price as we were before, but compared to our net demand, buyers minus dyers, which is a very important indicator, and we explain this to our Australian audience, that even though they have a much stronger spending wave going decades ahead than we do in most developed countries, even the dying of their large baby boom generation is going to have a muting effect on real estate, and real estate will not go up like it did before. It'll have more potential to rebound than, say, in the US or Canada or Europe, but it will not see another runaway boom like this. So again, demographics matter everywhere. Valuations matter everywhere. Debt matters everywhere. Consumer debt in Australia and Canada is way higher than the US. Government debt in Australia is one of the lowest in the world, so that's a big plus there. Australia is still one of the best houses in the global neighborhood in the smaller countries. Good demographics, low government debt, but they have very high consumer debt and very high bank exposure to this real estate bubble. In my estimates, my bubble model says 50%, give or take, is a more likely target. Martin North's 40% agrees with my model exactly. That's what it would take to get prices down to fair value. That's what he was estimating. I don't know how he got his numbers. They're the same as mine. I say if it overshoots, it undershoots, so I'm looking more at 50 to 55%. Nobody expects that in Australia. None of the leading economists did. But remember, in the US, nobody expected this little subprime crisis and this minor trend down in real estate prices while the economy was still booming to be a problem. It is a sign. Why would real estate prices be going down in a good economy? Because they're overvalued or because there's bad lending. So Australia is going to see their first recession in 27, 28 years. It probably won't start for a year. While I was in Australia, two important things happened. This US stock markets, if September had been a peak, my bubble model says within 3 months we should see about a 40% first crash. That's the sign of bubbles really bursting. 10% correction means nothing, even 20%. This has not happened. We're 2 months in and we're still only been down about 12% and we're bouncing again. My model says we should have been down by now. So the chances of scenario 2 that this is another correction, kind of like early 2018, and there's another leg of the boom well into 2019 before we hit our 90-year bubble buster model of all times, which would be like the 1929 to 32 crash 90 years later. That's the more likely scenario now. So that's an update. Something else important happened while I was in Australia. I've been alerting our subscribers that Bitcoin and gold were the two investments that were not following the bubble model like everything else, like other real estate crashes, like other stock crashes and stuff. They bubbled up on the bubble model. They crashed in the early stages on it, but they based out and bottomed out at levels higher than the bubble model would suggest. So Bitcoin was looking like it was basing out between around 6,000 and maybe 5,000 at worst. And we're saying, gosh, if it can hold that another so many months, Bitcoin could see another run up to new highs, 25,000 or higher. And that's a number Michael Turpin threw out at our Irrational Economics Summit. And he's even seeing higher than that now. But then Bitcoin just fell out of bed. So the latest analysis, Bitcoin is in its second bubble. People don't realize it bubbled up in 2013. It went up to $1,163, which sounds low now, but that was a huge run. And it crashed 87% to $152. Michael Turpin is saying that if this bubble crashes the same percent, that would take us to about 2,600. That's a really solid target if this second bubble is going to burst and then we have one more bubble. So that would give us an Elliott wave, 1 up, 2 down, 3 up. So 1 up would be into 2013, 2 down into 2015, 3 up into 2017, 4 down here, maybe into early 2019 or now, and then a 5th wave up. I would see that happening by 2019 along with the stock bubble. We also know that there's a hype phase to every new technology that comes out, like the internet, 98 to 2000. They went up way faster than other tech stocks when they were babies and had very little sales or earnings to show for it, and then crashed 95%, and then became the next big thing. So in the early stages, this happens. So if Bitcoin had based out another few months between 5,000 and 6,000, I've said, this is probably something people could consider buying for a 1-year run, could be 4 times. Right now, it's more questionable and iffy. I'm going to continue to watch it. If it does go down to that 2,600 number, then it could be worth some short-term speculation for a little bit of your money for people who are into this. So that's another thing that changed while I was in Australia. But again, it was a good trip. I wish it wasn't so far. I wish I didn't get such bad jet lag. Again, I get a week jet lag over there. I'm jet lagged most of the time I'm over there, and I get worse jet lag coming back. Coming back east is always worse on jet lag, and I don't know the reason for that. So I'm looking at maybe going back there next year again, and as soon as April. So things are hopping in Australia, and people are finally getting hip to no economy is recession proof, and bubbles do finally burst.